Okay, well, I make it 4 o'clock, so let's get started. Welcome to our webinar this afternoon, hosted by Palmers, which is our construction law update. I'm delighted to be joined by Debbie Jennings and Guy Richardson, both from Moore Kingston Smith. Welcome to you both. And Debbie and Guy are going to be talking about the VAT reverse charge and a budget update, and they follow Adam, who's going to be talking about construction law. So these are your speakers. Here's our agenda. If you're used to using Zoom and you've been on webinars before, you'll be familiar on the toolbar. There's an option for Q&A. So we are going to make sure that we have a time at the end of the session today for questions, and we'll run a live Q&A. So please, as we go along, put any questions you have into the Q&A panel. We'll try and answer as many of those live before we finish later on today. We are also recording this webinar, so if there is anything that you need to recap on, we will make a copy of this available on the Palmers website tomorrow. So at this point, I'm going to hand over to Adam, and I will see you at the end for Q&A. So over to you, Adam.
Thank you, Jo. Good afternoon, everyone. I'm going to be giving a brief construction law update today, largely based on the fallout from the terrible tragedy at Grenfell. It has affected the industry in a number of ways. We have a variety of new legislation coming in. I'm going to be briefly talking about what I'm calling the insurance fallout, which will become clear as I go through my presentation. I'll then be talking about the new Building Safety Act, which is currently being amended, and a bill is likely to be introduced before the summer recess this year. I will then be moving on to talk about the Building Safety Fund. And then lastly, a very brief update on Form EWS1. Next slide, please, Jo. So insurance problems. It's become apparent that since Grenfell that the insurance industry is sort of reeling from what happened at Grenfell. In particular, cladding firms are very much affected, but it's not just cladding firms, architects and designers. It's a real issue in the industry. Some of the exclusion clauses I have come across recently are quite heavily restricted. I've given 2 examples there, which I came across very recently for a client of mine. And you'll see there that essentially what the insurance industry is doing in PI insurance is limiting insurance and specifically excluding the combustibility, fire performance, fire safety requirements of cladding, as well as many other types of exclusions I've seen recently. Next slide, please, Jo. As a result of these problems, the Construction Leadership Council are currently undertaking a review. We're currently awaiting that, but both the CLC and the government are currently in discussion with industry leaders in the insurance industry and insurance companies to try and find a suitable resolution, because we have a situation at the moment where buildings are being designed with cladding systems, which is perfectly appropriate, but the employers obviously want to get their risks sorted so that they have coverage, but cladding subcontractors that are doing the design, architects that are doing design, are not being covered by their PI insurers. Next slide, please, Jo. I'm going to talk roughly about how we can mitigate the risk here. The contractual chain is now becoming alive to the insurance issues and the lack of coverage of certain companies, although it has taken them quite a while to get to grips with it. This all started sort of last year, beginning of last year, but now main contractors and employers are coming around to it. The first thing really to mitigate risk is to check your existing contracts and collateral warranties. And the reason why I'm saying that is because With PI insurance, the point at which coverage is accepted on a claim under your PI insurance will be the point at which the claim is made, not when necessarily the works were undertaken. So if you did a cladding system 5 years ago and you've just recently renewed your PI insurance and you have this exclusion clause within it, you may not be covered anymore, which causes problems for those, especially in the construction industry, where a lot of contracts are signed as deeds, which means that your liability period will last for sort of 12 years after practical completion. In addition, many very standard situation, as I'm sure everyone will be aware, of collateral warranties, which a lot of employers will insist upon, especially if there's a funder involved in the project. And you as a company may well be giving assurances and having contractual obligations there to third parties to ensure that your insurances are maintained and up to date. The one thing to really mention here is that this is about discussing these issues with both the employer, if you're contracting with the employer, and the contractor. Most standard form contracts, such as the JCT, will require you or any contractor or subcontractor to specifically inform a contracting party in respect of any issues with insurance. And what that means is that you have to sort of say to your employer, even if the project was completed 5 years ago, look, we're really sorry, guys, but our PI insurers are now seeking to exclude liability for fire retardancy. Here is an updated version of our new policy. Next slide, Joe. And how we mitigate that risk is very dependent on what the contracts and the collateral warranties say. So there'll be a reasonable endeavours clause or a best endeavours clause usually to ensure that you are securing the insurance required that the employer or the contractor wanted at the time the project was undertaken. There are a number of ways in which we can sort of pass on the risk. So one specific way, and pretty much one of the very few people that are still getting insurance for fire combustibility for cladding at the moment, are specialist fire consultants. So one way to pass on risk would be to pass on that to a third party by contracting with a fire consultant, but that's obviously going to cost money. Or alternatively, try and pass the risk back to the employer or the contractor. So most JCT contracts or similar contracts will have provisions in them that allow the employer or the contractor, if the person who should insure can't get the insurance, to then go and get insurance. However, as I've said at the beginning, this is affecting everyone within the industry, from architects, employers, contractors, subcontractors. Literally the only people really that can get this type of insurance is a fire consultant. And that's why it's important as well going forward to really negotiate new contracts with an understanding of any restrictions on your current PI insurance to ensure that, that the project is there. Next slide, please, Joe. That sort of concludes the insurance section of what I was going to say today. The next part is really talking about the Building Safety Bill, which will become the Building Safety Act should it pass through Parliament. And there's no suggestion, given the current split of Parliament, that it won't go through. A draft safety bill was introduced following the Hackett review, which is still ongoing. It was published last year and was put to consultation in Parliament in October 2020 by the Ministry of Housing. That's now happened, and essentially the consultation said that it needed more detail, and it's expected that this may well be brought back before the summer recess this year. Obviously, it will have to pass through the various stages before it comes into legislation. But from everything I'm reading and hearing about at the moment, this is looking like it's going to be enforced probably by the end of this year, if not the very start of next year. And it is quite a restrictive piece of legislation. as we will go through the major points of that legislation in a moment. Next slide, please, Joe. So the main purpose and intention of it is to ensure that each stage of construction, whether it be design, the actual construction of it, and also during the occupation of the building, that it's clear and responsible who's managing risks for fire. It establishes a whole host of new sort of requirements that are new to everyone. And it's the idea is to gather vital information that the building needs over its lifetime to manage and assess those risks. And the idea being to try and prevent another Grenfell. Next slide, Joe, please. Oh, I think we've gone one, two, go back one. Yep. So the bill is going to apply to all buildings, not just buildings over 18 metres, which is currently the position with some of the legislation that's out there, and obviously Grenfell being over 18 metres. Some of the more detailed and restrictive provisions will only apply to what they're classing as higher risk buildings, and they are defined currently as multi-occupied residential buildings with a height of 18 metres or more, or 6 stories, whichever is reached first. But that's not necessarily going to be the case when the bill goes through Parliament, and we'll have to see whatever revisions they make to it. But as it stands at the moment, the bill applies to all buildings, but some of the more restrictive provisions will only apply to taller buildings. Next slide, please, Joe. So I'm going to take you through briefly, as quickly as I can, some of the key provisions of this new bill. The cornerstone, really, of the bill is to introduce this new building safety regulator, whose key functions are going to be to secure the safety of people in and about buildings and to improve the standard of the building. The building safety regulator is going to be a part of the current health and safety executive, and following those key objectives, and in achieving those objectives, their functions are going to be quite wide-ranging. They're there to implement a new regulatory regime. They're going to be overseeing and monitoring the safety and performance of buildings, and that will be an ongoing review system. They're going to be establishing a system for giving building safety information. For example, it was specifically recommended in the Hackett report that the existing confidential reporting on structural safety scheme be extended to cover wider engineering concerns, including whistleblowing in respect of any issues with building safety. And this, I guess, comes down to some of the things that have come out from the review in terms of the safety of the products used on Grenfell. It's going to set up various new committees, such as the Building Advisory Committee, which will produce advice and information to the building safety regulator. It's going to have a residential panel, for example, to give residents of buildings that have cladding systems a voice. And these are just some of the various powers that it's going to have. It will have wide-ranging powers to both enforce compliance with this new legislation, and they will add to the existing powers of the Health and Safety Executive under the Building Act 1984, which is currently in force. There are essentially 5 duty holders during the design and construction, which will broadly align with the CDM regs as we know them now. Next slide, please, Joe. There will be a new gateway regime. This is entirely new. There's essentially 3 gateways. Gateway 1 will occur before duty holders are required to be in place, and I'll move on to explain who the duty holders are. It's quite complicated, but this is basically the planning stage. The second gateway will occur during prior to the construction work beginning, and is kind of described as a hard stop. So this is really the second test, really, before works begin, to ensure that the building safety regulator is satisfied that the design is compliant with all new requirements. Next slide, please, Joe. The third gateway is really designed to be at completion, and this is going to require duty holders, and it's going to have a proper handover process for prescribed documents, and in particular documents to the accountable person. The accountable person we'll move on to shortly, but that accountable person is essentially going to be the person who is accountable for managing the risk of the building going forward. Whether if we're talking about a block of flats, it may be the management company, it might be a specific person involved in the maintenance of the building, for example. And they're going to have to set prescribed documents to the building safety regulator, including as-built building drawings, for example, and all those types of stuff. It's going to be very similar, I think, in practice to the current health and safety file that has to be produced under the JCT contracts anyway. So theoretically, the information shouldn't be more onerous on anyone. Next slide, please, Joe. One of the key provisions of the Act is going to be that all this information, sorry, thank you, Joe, is going to be held digitally. So very much similar to, I guess, what many people are using now with BIM. So there's going to be this golden thread to ensure that the right people have the right information at the right time, and to ensure that the buildings are safe and that building safety risks are managed throughout the building's life cycle. And that's what they refer to really as the golden thread. That's the idea behind it, to ensure that the building's safety risks can be managed throughout the entire lifespan of the building. Next slide. No, not next, sorry, Joe. There'll be mandatory occurrence reporting. This will be compulsory, and it will be compulsory to report any structural and fire safety occurrences that could cause or may cause a significant risk to life to the building safety regulator. The accountable person here, as I said already, it's a new role, and it will be a duty holder who is following occupation of the building, really, and it will fall to a person or entity with the control of the common parts, and that's, as I said, usually going to be someone that has a repairing obligation to the common parts. So potentially, in most cases, will be the management company, but could also be construction companies if they are tending to hold on to the freehold and not set up a specialist management company. The accountable person is going to have a wide-ranging statutory obligations. So they'll have to register the building, they'll have to apply for the assurance certificate, they're going to have to do duty assess, building safety risk assessments, control, prevention, and assessments on any impact of a major incident. Next slide, please, Joe. We're also, well, actually, the first thing to say on the appropriate person is the fact that if you fail to carry out your duties, there will be severe penalties under this legislation, including fines and even imprisonment. So if you're a director of a management company, for example, you can expect the bill to reach behind that limited company and go after the directors and the persons that are responsible for managing the building. We're also going to have a situation where there's going to be a building safety manager as well as an appropriate person, and this can be a person from an organisation with day-to-day management of the fire and structural safety of higher risk buildings, and this will only apply to high risk buildings. It's also going to massively reform the building control regime. The bill will amend the Building Act in relation to provide that the building safety regulator is the building control authority for higher risk buildings. So with higher risk buildings, rather than going to building control under the Building Act as you would now, you would have to go up to the building safety regulator instead, and they will have to approve and inspect the building and sign it off. There's also going to be further obligations for residents, so they will be obliged to properly maintain and repair resident items to ensure that the appropriate person can carry out their duties. There's also going to be a homes ombudsman service, for example, and this is going to be for residents to be able to, similar to any really ombudsman service, if they have a complaint or an issue with any of the building, to raise that with the ombudsman, or if they feel the accountable person isn't doing their job, haven't got access to the relevant information. Next slide, please, Joe. So that concludes a very quick run through of the Building Safety Act. We're looking to receive further information very soon on it, certainly as it goes towards being introduced to Parliament. The next thing to really talk about very, very briefly is the Building Safety Fund. You've probably seen in the news that this has recently been extended. The government fund, they've increased the fund, I believe, by another £3.5 billion. And they've introduced a walking watch relief fund of 30 million as well. The government is going to fund replacement of unsafe cladding in all buildings over 18 metres. There's also going to be a finance scheme available for those buildings that aren't over 18 metres but are between 11 and 18 metres. They've also extended the date for applications for, currently it was set much earlier on, but they've now extended it to the 30th of June 2021, with the works expected to have started by the 30th of September 2021. And that's really just a brief update on the Building Safety Fund. Next slide, please, Joe. Lastly, for my part of today's seminar, before I hand over to Debbie to talk about VAT reverse charge, is to talk about form EWS1. As you will probably all be aware, this is a form that was brought out. It's not a new form, but it has been recently updated. And some of the updates to it is that it applies to all residential buildings now. It was primarily for the residential buildings, but now it's been amended for mixed use buildings, so where you have commercial units on the ground floor or the first two floors and then the rest is residential. They've also removed, as far as I'm aware, the height requirement. So it was for buildings over 18 metres, but it now applies to all residential buildings. The process is really designed to have two options. One, that the external wall materials support combustion, or are unlikely to support combustion, I should say, sorry, or that combustible materials are present in the external wall, with then options as to what the fire risk is for those, whether they're low, medium or high, for example. The real thing to mention here is that the form EWS1 is causing a lot of problems in the property market, if you like, because mortgage companies are refusing to lend on any building that doesn't have an EWS1. So it's going to be really important going forward for selling properties to ensure that these EWS1s are completed. And that ends my presentation. So thank you very much for listening to me. I'll now hand over to Debbie Jennings from Moore Kingston Smith, who's going to talk about probably the more interesting subject of VAT reverse charge. Over to you, Debbie.
Okay. And to domestic VAT, we are now into it. So there's a lot of questions, both before it came in. Questions was it going to come in because it had been postponed? And then obviously there's been more practical questions before. And the whole thrust of how we've approached this, our style anyway, is to make it a pretty practical session. Next slide, please.
So the rules. So I think what Debbie was saying just before she got interrupted by the technology. We had hoped that these rules were going to be canned shortly before the 1st of March. There was a lot of backlash against it, but unfortunately that didn't happen and the rules did come into force. And we are now stuck with them, and these are now something we have to live with. Why were they brought in? Well, they were brought in as a fraud measure for what's known as missing trader fraud, which is broadly speaking where a contractor might invoice their main contractors for the works that they do, charge VAT, collect that VAT in, and then not actually pay it to HMRC and abscond, which means that the HMRC are out of pocket of that VAT. So they are trying to tackle that, basically. It's debatable as to how much of that is really going on and how much of that this will really solve. But that is nonetheless what HMRC are doing. They are very keen to crack down on fraud these days. The mechanism that they've used is a well-trodden path. They've used this in other areas, and so they know it. So from their point of view, it's relatively easy to implement. That's not necessarily the case for the actual users, the actual VAT payers on the other side. And it is, HMRC have also said that they'll do a light touch. So in these first sort of 6 months, they're not necessarily going to crack down particularly hard if people get it wrong, which is good, because I expect that quite a lot of people will get it wrong. Judging by the conversations that we've had, it is a bit of a struggle to understand. So who do these rules apply to? Well, first of all, we've got the concept of specified services. So it's not on everything that that construction businesses do. There are a predefined set of things that you apply these rules to, and if your services don't fall within that, then you don't apply this rule. You're back into normal VAT. The government website is pretty clear on these things. It gives the examples. So it's fairly easy to navigate whether or not your services apply or not apply. You just have to look at that list and get it right. What's perhaps slightly unhelpful or slightly confusing is it does not apply to zero rated supplies. So if you are in a position where you're providing some services and it qualifies for the zero rate, so you're not actually charging VAT, or more precisely, you're charging VAT at 0%, and it doesn't apply there, which adds a layer of complexity that probably will trick some people out over the course of time. And this is not a sort of, we can decide to apply it or not. It's not a choice, it's a requirement. We've got to apply these rules if we fit the circumstances. So here's an example of what is included within specified services. And broadly speaking, it's what is qualified as construction industry scheme services. So if you are obligated to register for the construction industry scheme, there is a good chance that your services will come under this banner. And there's a few simple examples there on the screen. It's relatively intuitive when you look down the list and you can see it there. And again, we've got on here the fact that it's not zero rated supplies. So if you are building new residential, which is the classic thing where you apply the zero rate, then actually these rules potentially don't apply and you don't need to worry about it, which is good. This is where, again, things might get tripped up, but the rules are relatively straightforward, if not necessarily intuitive. Where we have a situation of mixed services, so you are providing services to a main contractor or anybody, and they include things that are on the specified service list and things that are not. Effectively, you treat the whole thing as if it is under the specified services. So it's a one-size-fits-all in that regard. Which might be a little bit strange if you're in a situation where you've got the majority of services are not specified and only a couple are, because then you're in a situation where you have to apply it across the board, even though you're only, relatively speaking, doing a small amount. So you can almost think about, or the best way to think about it is that the DRC applies as a default position unless it doesn't apply. If you start from that way around, that's probably the best way to look at it and more likely to get you to the right answer, rather than working from the basis of its normal VAT treatment unless the DRC applies. So there are some fairly simple categories that you need to go through to decide whether the DRC applies. Is it a specified service? If the answer is yes, move on to the next one. Is your customer VAT registered? If the answer is yes, move on to the next one. Is the customer CIS registered? And is the customer onwards selling the services, i.e. they are not the end user, which we'll come on to later. And the crucial point is that you have to tick all of those boxes. So it is an and. If at any point you don't tick one of those boxes, the DRC does not apply, and you ignore that rule and you are into normal charging of VAT. So it really is almost like a bit of a checklist that you need to run through. And therefore, conversely, when does it not apply? Well, it does not apply when any of these things apply. So if it's not a specified service, if it's not a VAT registered, if you're not CIS registered, if the customer's not an end user, any of those boxes ticked or crossed or not ticked in the case, then you don't apply these rules. And an interesting one at the end there, that, the customer makes an onward supply to a connected party. So this is essentially where you maybe are acting for a group. So you're invoicing one group company, which maybe that group company isn't the end user, but another company within that same group is the end user. Effectively, the rules treat the entire group as being the end user, and so you get into a position where you aren't applying the DRC because they qualify as an end user. This is again something that could quite easily trick things up and find yourself applying the DRC where you don't actually need to. And similarly, where the supplier and the customer are a landlord and tenant. So this is envisaging the case where maybe a tenant is doing works on a building that they're leasing, or a landlord is doing works for a tenant under a leasing arrangement. These rules won't apply in those circumstances. So what is an end user? Basically, an end user is anybody who's receiving the specified service for any purpose other than making an onward supply. What does that mean? Usually it means it's the property owner or a developer who's building the property to sell it on to somebody else. Basically, it's somebody that's at the end of the chain of the construction work. They're not just contracting out construction services and they're providing a construction service to somebody else. And what's the obligation of an end user? Well, they have to issue a written confirmation of their status to suppliers. So end users need to know that they are an end user, and they need to tell their contractors they are an end user. And HMRC give a nice example of a simple statement, relatively speaking, of what they can put on those confirmations. And it's that confirmation that's necessary for the contractor to be able to say, my customer ticks the end user box. I therefore do not need to apply the DRC. I need to charge VAT, and I don't need to do this whole reverse charge malarkey. And then we've got the situation where customer position changes. Some maybe, and I can't think off the top of my head an example of where this might be the case, but there are cases where a customer may cease to be an end user. They were planning to keep the property, but maybe they sold it on mid-development, and then they effectively become a subcontractor in the middle between what you're doing and who is eventually going to actually own the building. Again, it falls on the customer, the end user, to notify the supplier of the change. And then the supplier and the customer basically agree how to deal with that change. And broadly speaking, from the point at which that change occurs, they need to start applying the DRC. If that falls within an invoice period, so exactly, we've got a valuations being done, maybe it falls in the middle of the month, you can agree basically to apply the new rules from the start of that period, from the end of that period, during that period. You've got a bit of flexibility there. But the important thing is that once that change has occurred, you've got to take some action and you've got to change something. Probably relatively rare when that's going to happen, but it might happen from time to time. And again, it's something that people will probably get caught out by, I imagine, over the course of time. So how does the reverse charge actually work? What does it really mean? Many businesses will not have come across this before unless they've been trading internationally, and will have no idea what really happens. So if you're the supplier, you're the person making the invoices, and you are now in a situation where you need to apply the DRC, the reverse charge, on your invoices. Basically, first of all, you do not charge VAT on that invoice. So whatever the net amount was before, it stays the net amount, and you just do not add up 20% onto your invoice. And you state on your invoice, this is subject to the reverse charge. So from a supplier point of view, if you are issuing an invoice, it's actually relatively simple in that sense. You just don't do something and you put an extra statement on your invoice, relatively easy. The customer pays the total invoice, which is the net amount that it would have been. And then on their VAT return, they have to account for imaginary VAT, if I can call it that. They pretend that output VAT had been charged on the invoice, put that in their box 1. And then they also put an equal and opposite amount on their input VAT. So it becomes neutral from their point of view, but we've essentially put on our VAT return VAT that didn't actually exist. Where this can be difficult for the customer is if they don't have the right to recover that VAT. So if they still have to put the output on their VAT return, but they can't recover the input, and that therefore creates a cost for them. So what are the key issues that this whole thing creates, basically? Cash flow is the number one. Many contractors, subcontractors rely on that VAT flow in order to be funding their business. They get to charge VAT to their customers. They get to then hold on to that VAT potentially for up to 3 or 4 months until they actually have to pay it onto the revenue. And for some businesses, that working capital is actually quite valuable. And taking that working capital out of the system can put stress on their finances, which obviously can have knock-on effects to the main contractors up there as well. Invoicing. Obviously, there's a risk here that people get their invoicing wrong, and there are disputes, and we end up in a situation where customers and suppliers are disagreeing about how things should be invoiced. And we've already started to see that less than a month after these rules have come into force, where there is disagreement as to how these rules need to be applied, who is the end user. It's creating hassle and it's creating confusion. Accounting and VAT returns. This is something that many finance teams, especially at the lower end, where people maybe actually it's just a subby who's trying to comply here. This is going to go wrong, and HMRC might start asking questions. That's something nobody wants to deal with. And altogether, it could be quite hard for businesses to comply with these rules. And at this point, they've said they're going to do a light touch, but we don't know what happens after the light touch ends and what they will do, what HMRC will do when there's non-compliance. Will they crack down hard? Will they be a bit more forgiving? We don't know. We hope that they'll be on the forgiving side and they'll understand that this is going to take some time for people to learn how to operate it properly, but they may not. They've got a fair bit of money to collect in to try and refill the coffers, so maybe they'll use this as a way to do that. And just last point there are probably going to be lots of HMRC inquiries over the course of time on this. I expect to see for construction businesses VAT inquiries quite frequently as they try to see are construction businesses doing this properly, and can HMRC demonstrate the rules are working. So I've covered that off non-compliance. I'm going to skip past that. Yep. And so in a roundup, I hope I've done a relatively decent job of subbing in for Debbie there. I'm not the VAT expert, but I've got a little bit of an idea. I think the key takeaway here is that if you haven't already got an understanding of these rules, now is the time to do it. You do have a period where HMRC are not going to crack down on people. but that's a good period to use to get it right and try to make sure that you're compliant. One of the key things that you need to do is agree the VAT treatment with your customers or your suppliers up front. You get it right up front and everybody knows what they're supposed to be doing, things should run smoothly. If it's not agreed up front, as we have been seeing, then confusion can start to creep in. People start getting things wrong, and then it just leads to time wasted without any benefit to anybody. So I'm just checking, we've got nothing coming through on the Q&A. So I'm going to move on to the budget. So a little under at the beginning of this month, Mr. Sunak stood up and delivered his budget. And I'm going to talk through what I think are the key takeaways. I'm not going to go through everything. The key takeaways as they pertain to the construction industry more than anything. The first thing to note that we all perhaps were a bit scared that there was going to be some massive tax hikes coming. Undoubtedly, the government have spent a hell of a lot of money over the last year. In fact, they've spent more money than at any other time other than World War II, which is saying quite a lot. So there's been a hell of a lot of spend, and that money's got to come from somewhere ultimately. Generally speaking, the government run a budget deficit of around about 3 to 4%. And in broad numbers, they spend around about 800 billion historically and receive in around about 800 billion, give or take 3 or 4%. For 2021, the expectation is that they'll receive roughly 800 billion, but they'll have spent 1 trillion. So that has put the budget deficit considerably higher than the norm. And ultimately, that's got to be paid through by borrowing. There isn't going to be a way to get out of that. They're going to have to borrow money to spend it, or they have borrowed money to balance that book, as it were. And what that has led us to is a position where basically the national debt is, roughly speaking, 100% of our GDP. Our GDP is around about 2 trillion, give or take, and our national debt's going to be pretty much the same number. That puts us in a precarious position because we're like any other business, really, any other borrower. Lenders look at us and decide whether or not we've got a risk profile and whether or not they can confidently lend to us as a country. And if at any point they get a little bit nervous about our borrowing potential, the ability to repay the loans that we've taken and the ability to service them, that can impact on our interest rate, which means that to service that debt, or even to get more debt to replace the debt that we already have, could become quite tricky. And that is a problem for a country. That's when the wheels can really fall off. Which is why this budget was really about spending, investing and growing. We can't tax our way out of this problem. We've got to grow our way out. We've got to increase that GDP number to create more wealth and to facilitate the pay down and the service of all that debt. If we try to tax our way out, we potentially stifle growth, and that basically reduces our top line and reduces our ability to pay off all that debt, which is not good for the country. So that's why we didn't see any major tax rises, at least initially, which was probably quite a positive thing in the end and quite good to see. We have seen bounded around lots of comments on stealth tax budgets. What people are referring to here is the fact that Rishi has frozen things like the personal allowance for basically 5 years. And what that really means is that we've got this personal allowance that says you can earn up to, roughly speaking, 12.5k without paying any tax on it, which is quite nice. That level is going to stay put. So as inflation ticks up over the course of the next few years, that 12,500 becomes less valuable. It actually becomes worth less over the course of time, and that essentially means that our tax is going up in a roundabout way without actually increasing the rate of tax. Most people who earn a decent amount, higher income earners, they're unlikely to notice the difference really. That's probably not going to make a lot of difference to them, and it's probably going to, wash over without them noticing. Lower income people, that might be a different story. People who are already struggling, people who are already on the breadline, that actually could have a big impact. And I think that's why there's been a fair bit of reaction to that. So that's the budget. There wasn't a lot of tax in there, actually. It was mainly about investing and growing. And so let's just go and take a look at the key measures that were put in place. The furlough scheme. The furlough scheme was extended out to 30th September 2021. Effectively, when you look at the roadmap, which is basically trying to get life back to normal by the end of June, that's giving an extra 3 months beyond that point in acknowledgement that actually things aren't just going to return to normal. Business isn't going to be able to get back to normal straight away. It's going to take a little bit of time. So the government are giving a bit of extended support. That support is going to get tapered off though. So there's a little table there that explains how it's tapering off. Broadly speaking, once we get back to normal in July, hopefully, if the roadmap works, businesses will be expected to start to contribute more to those furlough amounts, so that in a progressive way to get back to normality and get back to the point in October where actually it all ends and everybody's got to pay full wages, no more furlough money. The cap of 2,500 per month per employers is there again, so that stays in. And employers will have to continue to make employers' national insurance and pension contributions. So broadly speaking, things are staying the same, except that the system will taper off. Then we move on to loan schemes. So we've obviously had the Sybil's loan, we've had the Bibbles loan, which is the sort of little brother to the Sybil's. We've now got the recovery loan scheme. So this should be available from the 6th of April 21, which is not too far away now. Loans of up to 10 million or 25,000 to 10 million. Government's going to back 80% of those loans. And what's probably quite positive actually is that businesses will be able to apply to them even if they've taken some loan schemes before. So they won't be excluded if they've already taken loans. And this is all part of that invest to grow. The government is willing to give businesses loans to help them get back on their feet and get that growth going. And there's also going to be some restart grants, but they're only going to be made available for certain sectors. So this is really about supporting those sectors really hit, i.e. retail and hospitality. So in terms of construction, not really much help there. And to be fair, many construction businesses have managed to continue operating during this period. So it's understandable they want to target those extra grants to the businesses that haven't been able to do that. Self-employed support scheme. We've got a few further grants coming on here. We've got a 4th grant scheme, which is for period Feb to April 21. And that's going to pay out 80% of 3 months average trading with an overall cap of 7,500. And it's going to be in a few weeks' time when those claims can be made. And then we'll have a 5th grant for the period from May to September. So very much aligned to the furlough scheme there. Again, 80% of 3 months average trading, an overall cap of 7,500. But we then start to get a qualification in here. So it's only going to be for those who can demonstrate that their turnover has fallen by more than 30%. And if they can't demonstrate that, i.e. if they haven't been hard hit, then actually they're only going to get 30% of that available grant. The calculations there are probably going to get quite complicated. What is more important in these schemes is that people who have now submitted their 19-20 tax returns can access these. And that was a problem for many people who had just become self-employed and didn't have the history that was necessary under the previous schemes. So that's a positive step in the right direction. That means that people that have thus far been excluded can now access these grants and get the support that they need. Owner managers or directors. This is basically people who are directors of their own business. Maybe they're reliant on dividends from those businesses, or they're getting paid a salary, but they're not exactly furloughing themselves because they are the business and they can't furlough themselves to be able to keep going. Unfortunately, still no help for them. The government do seem to have let that fall through the cracks, and despite many people putting forward that they need to do something about it, they haven't. They seem to have just let those people split through the cracks. So unfortunately, not much help there. So that was the main support schemes. Then we start getting into the taxes themselves. So obviously, SDLT was probably one of the bigger things that had a lot of hype leading up to the budget, because we were facing this cliff edge of transactions that were going to flip over from having relatively little SDLT to pay, if any, to having quite a lot. And as everyone hoped, they did extend the scheme. They seem to be very committed to keep in the housing market going. So to let that drop off a cliff was too unpalatable for them, so they extended it. But they extended the £500,000 nil rate band up until 30th of June, so which is very good. Very good for yours truly, who's trying to buy a house right now and would quite like to get his completion over the line. Definitely wasn't going to happen before the end of March. Could happen before the end of June. So I'm quite grateful that they extended that. From 1st of July to 30th September, we then start to progressively get back to normality. And so that nil rate band drops down to 250,000. Broadly speaking, if you've got a house purchase over 500,000, that means you're going to pay an extra 12,500. So there's still a bit of a cliff edge there when it comes to 30th of June, but it's not quite the cliff edge that it was. And then once we get to 1st of October, we're back to the normal £125,000 nil rate band. And broadly speaking, the difference between now and then is up to £15,000, depending on your situation and your house price. So quite a difference, but overall, it's a good thing. I personally would like them to see them have a look at SDLT and revamp it completely. I don't think it's that progressive a tax, but they haven't done that so far. What about investment? Well, their biggest and probably their big announcement that they wanted to make a big deal out of was FREEPORTS. So they are opening 8 FREEPORTS across the country, and this is their answer to Brexit, effectively, to try and increase trade. Those FREEPORTS, there'll be no business rates in those FREEPORTS. There'll be no SDLT on purchases, so they may be thinking a little bit about my plans for SDLT. And there'll be enhanced tax relief on plant and machinery and buildings in there. So they're ramping up this idea. They're trying to do them to increase trade and to deal with the Brexit, and they're making it they're giving tax incentives to get people investing into those FREEPORTS. These aren't new. We have tried FREEPORTS before in the UK back in the day with limited success. Some areas of the world have seen massive success with FREEPORTS. They've done a really good job. But quite often, all they really do is they move jobs from one area to another. So they move jobs from an existing area into a FREEPORT area, but they don't necessarily create any more jobs. They don't necessarily create any more trade. So the economic impacts of FREEPORTS may not be all that good. It might be a nice thing for the government to say, but will it actually make a difference? Only time will tell. But for the construction industry, well, that's maybe not such a bad thing, because actually there's still going to be activity. There's still going to be people who want to build stuff within those areas. There's still going to be areas in and around the FREEPORTS where there's going to be activity. So it does present opportunity in the construction industry to do some work and to earn some income. So I think that could be good for the industry, if not necessarily for the country. More on taxes, loss carryback. So at the moment, businesses can only carry back losses 1 year, basically. So you make a loss this year, carry it back to last year against profits that you might have made, and you can get some tax back that you might have paid. Quite a nice system. What they're now doing is they're extending this. This applies to companies and unincorporated businesses, so essentially the self-employed, which is quite good. And they're going to allow you to carry back up to £2 million worth of losses for an additional 2 years. So basically that means you can make a loss now and carry it back 3 years and be able to get some tax back, which is quite nice. So that's pretty good. And the first losses that you can carry back are going to be for the year ended 31st of March 2021, which is fantastic. So that actually is a good opportunity. Anybody who thinks they're going to make a loss in that period, talk to your accountant about how you might be able to get some tax back by utilising those losses. Another thing that was widely reported was the super deduction. What is the super deduction? Well, basically for qualifying expenditure or expenditure on qualifying assets between 1st of April 21 and March 23, you're going to get 130% first year allowances, which basically means for every £1 you spend, you get an extra 25p back, which is pretty good. It's pretty good if you were planning to spend that money already. It might mean that you advance those plans. But in terms of if you had no intention to spend that money or you haven't got the cash to spend, it's not really that much use. What this is really targeting at is big business. This is all part of that invest to grow strategy. Let's get big business and invest in money as quickly as possible in the kind of stuff that we want them to invest in, so that we can collect our VAT, so that we can get businesses making profit and get them generating profit, such that we can tax them to corporate tax, such that people are earning money, which means that we get income tax. So this is that invest to grow strategy here. And then we're on to the main tax increase, corporation tax. It is going up to 25% from April 23. So a couple of years away, but we know that that's what's going to happen. However, thankfully, it's not happening for everybody. It's happening for the larger of businesses, businesses with profits over 250k, which takes out a vast swathe of small and medium-sized businesses. For the smallest businesses, the current 19% rate is going to be retained on profits less than 50k, which is pretty good. And then there's going to be a tapered rate between the two. This is essentially a tax the rich policy, tax the big business, tax the businesses that have done pretty well during lockdown, and leave the smaller businesses who have not done so well out of the equation, which isn't too bad, I suppose. So probably for many people on this webinar, this isn't going to be a big problem. Obviously, the bigger businesses, they may not be all that happy about it. And just something I'd like to just point out here. This is back from May 2017, when the UK was proposing a 90% rate. The Conservative proposal was that they would get it down to 17. That was supposed to have happened by now, but it isn't. And Labour were proposing that it needed to be at 26%, which was all below the G7 average. We are now in a situation where the Conservatives are putting the rate up to 25%, which, broadly speaking, looks a bit like a Labour policy. So we are in a rather strange situation where we've got a Conservative government acting in a rather Labour fashion, which I don't think any of us expected to be in. And then finally, capital gains tax. We were inundated with clients conducting transactions during the period leading up to the budget, for the fear that the corporation tax and the capital gains tax rate was going to go up. They'd already tapped entrepreneurs relief back in 2020, back in the early parts. And there was a lot of talk about aligning CGT rates, which are quite generous at 20% or 28%. With income tax rates. So lots of people were cashing in with the rates as they stood, in the expectation that that would be one avenue that the government would take to start to refill the coffers. But there was no change. There was nothing in CGT, and actually things are staying put for the moment. So I think a lot of people breathed a sigh of relief. Some people may have felt, well, maybe I shouldn't have done that transaction now, but you can't predict these things, and you take your luck. And then finally, we had tax day, which occurred yesterday. A new concept in the UK. Normally on budget day, pretty much everything gets released, all the legislation, all these different things, and we get to dive in, understand it. This time around was a bit different. They did quite a lot of the headline announcements on budget day, but then they said they were going to be announcing more policy on the 23rd. And so yesterday we were waiting with bated breath to see whether or not there was going to be some new announcements, some things that they didn't announce in the budget, some tax rises, and thinking that maybe they were going to try and sneak some stuff through. It doesn't look like they've done that. It seems that all they really announced was a bunch of consultations, which basically means that they're just looking at engaging with the wider public to see how they might implement some of the things that they want to implement. So it's a good guide as to what is coming up, without necessarily knowing exactly how that is going to come up. So what were the key things that I picked out relevant to the construction industry? Well, residential property developer tax is probably the most significant one. And if I could rebadge this, the Grenfell tax. This is basically the government saying we are going to try and raise a tax in order to pay for supporting homeowners who need to correct cladding on their buildings that up until recently they had no knowledge was unsafe. And what they've said is they're going to apply this to the largest development companies. They haven't necessarily defined what largest means and what exactly is going to be captured there, but my guess is they're talking about large house builders. Now, I think everybody will probably agree that it's very good that the government are helping homeowners to sort out this problem, and willing to put money in to pay for it. Whether or not this tax and where it's directed is particularly fair, that's obviously a lot more subjective. The second thing, MTD for self-employed and small business, MTD making tax digital. Broadly speaking, this is what I call PAYE for people who aren't on a salary. At the moment, if you earn a salary, you pay your tax progressively through the year as you earn through the PAYE system. It's quite simple in the employee sense because they just get their net money. They know that they've paid the tax on it for the most part, and therefore they can happily put it in their back pocket, spend it, and that's good. The government get their cash in real term, so they're happy, and it's just a bit of a pain for the employer to actually operate. If you're self-employed, you've got a form of PAYE in the sense that you pay your tax usually in 2 installments in a year, once in January, once in July, but it tends to be behind the event. And if you're a small business, then you're paying 9 months after your year end, so 9 months after the profits have been generated. And if actually you generated all your profit in Q1 of your financial year, you're almost a year, you're almost 2 years behind when the profits were actually made. Large businesses already have a sort of PAYE scheme called the quarterly instalments payments, but most businesses are, most companies are paying tax in that 9 monthly period. What they're essentially saying here is we are going to look at changing that. We are going to look at using Making Tax Digital, which has been applied to the VAT world, to try and help us collect tax early. And what's that likely to look like? Well, I think it's likely to look like quarterly reporting. I suspect that what's going to happen is self-employed people and smaller businesses are going to need to make quarterly reports to the revenue on which a tax will need to be based and on which tax will need to be paid on a quarterly basis in order that they can collect their tax a little bit earlier. And finally, simplification of land and property VAT. As many people on this call will know, when it comes to property, we can have 4 potential VAT systems going on. We can have exempt, we can have 0%, we can have 5%, and we can have 20%. And actually determining where you fit in that cycle can be sometimes a bit tricky. So what they're talking about here is to try and simplify that. And that could be a double-edged sword. On the one hand, that's probably a good thing. Any simplification of tax and making it easier to apply is good, in my opinion. But it depends on how that simplification operates. If what it does is bring more things into 20% tax and ultimately means that people are paying more for those services, that might be a little bit of a bad thing. So watch this space on that one. We'll see how that pans out. And just before I end, the other thing that wasn't in the announcement again was CGT. Although they didn't change anything at the beginning of the month, we probably expected them to have a consultation on whether or not they will be aligning the CGT rates to income tax rates, but they didn't. Now, whether that means they've already made their decision, and we're going to find that out later on, or whether that means actually a Conservative government, that's a bridge too far, they can't go down that line and they're not going to touch it. Time will tell. We don't know. Hopefully, I'd say it's the latter. I do think that capital gains an important part of an economy and developing things, and I think that it's right that we should have a slightly smaller rate there to incentivise people to invest and to put their money into capital projects. Otherwise, there's a danger that people won't invest in that sort of thing, and ultimately our growth could be stifled. And that is the end of my presentation there. I haven't seen any questions, although to be fair, I can't quite access. Oh, there we go. So I will close things off there, and I'll pass back to Jo.
Great, thanks very much, Guy, and thanks for stepping in on the VAT reverse charge as well. That was very brave of you, so thank you very much. Okay, well, that brings our webinar to a close today. As I said, there will be a recording made available on the Palmers website. So thank you for your attendance today. We have slightly overrun, so I do apologise for that. And I will leave it there. Thank you.